Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for the final time this week. It's Friday the 22nd of September. There are several places you can find this show. Look for Peter Lewis's Money Talk on Spotify, Google Podcasts or Apple Podcasts, where we're one of the most listened to financial podcasts in Hong Kong and Singapore. You can go to my website, peterlewismoneytalk.substack.com, where you'll also find my daily newsletter. On Facebook, I'm Peter Lewis Money Talk, and on Twitter, at MoneyTalkR3. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, in a surprise move, UK interest rates have been left unchanged after the Bank of England said price rises were slowing faster than expected. Interest rates were held at a 15-year high of 5.25% after 14 rate rises in a row. In a knife-edge vote, the bank's Monetary Policy Committee was split 5-4 in favour of leaving rates unchanged, with Bank of England Governor Andrew Bailey casting the final and decisive vote. It comes after figures on Wednesday revealed an unexpected slowdown in inflation in August. The bank said there were also increasing signs that higher rates were starting to hurt the UK economy. The Hong Kong Monetary Authority maintained its base rate at 5.75% Thursday after the US Federal Reserve kept rates on hold for the second time this year. The HKMA said it was premature to conclude whether the US rate hike cycle has been completed, and the high interest rate environment is likely to last for some time. In an escalating dispute between India and Canada, India has suspended visa services for Canadian citizens amid a row over the killing of a Sikh separatist on Canadian soil. On Wednesday, India warned its citizens and students contemplating travelling Canada to exercise utmost caution because of growing anti-India activities and criminal violence in the country. The number of Americans filing for unemployment benefits, which is considered a proxy for layoffs, fell by 20,000 to 201,000 in the week ending September the 16th. That's the lowest since late January, and well below market expectations of 225,000. Meanwhile, continuing claims fell by 21,000 to a new 8-month low of 1.66 million in the previous week, indicating the unemployed are having an easier time finding new work. A resilient labour market and the potential flow-on impacts on inflation could prompt the Fed to leave rates higher for longer. On today's programme, I'm joined by David Friedland, Managing Director of Asia Pacific at Interactive Brokers, and Andrew Sullivan, founder of Asian Market Sense. With a view from Australia is Toby Lawson, CEO at Statton Partners. On Wall Street, all three major US indices fell sharply on Thursday in a third day of declines as Treasury yields hit 16-year highs. The S&P 500 slid 1.6% to a 3-month low of 4,330. The Dow dropped 370 points, or 1.1% to close at 34,070. Rate-sensitive tech shares were under pressure as Treasury yields moved higher. The Nasdaq Composite Index dropped 1.8%, touching a 5-week low of 13,224. US Treasury yields rose Tuesday after a hawkish FOMC increased investors' fears that interest rates will stay higher for longer to combat persistent inflation. The yield on the benchmark 10-year US Treasury hit a new 16-year high, rising 8 basis points to 4.49%. That took yields to their highest level since October 2007. Longer-dated US Treasuries also sold off, with the yield on the 30-year bond rising 15 basis points to 4.57%. That's the highest since April 2011. And the 2-year yield touched a high of 5.2%, reaching levels not seen since July 2006, before retreating later in the session to 5.15%. The yield on 10-year Japanese government bonds rose to its highest level in a decade. Ahead of the Bank of Japan's monetary policy decision today, the 10-year JGB yield rose to 0.75% on Thursday. The dollar index, which tracks the buck against a basket of 6 peers, hit a 6-month high earlier in the day before falling back to be flat at 105.39. The offshore yuan fell for the 4th day in a row, even as the PBOC set the daily reference rates for the currency at the strongest deviation from market estimates in history on Thursday. The yuan weakened as much as 0.33% in onshore and offshore markets, and it was trading at 7.3064 renminbi in Shanghai. Stocks in Hong Kong tumbled to a 4-week low. The Hang Seng Index declined for the second straight session, losing 230 points, or 1.3%, to 17,655. That's the lowest since August the 21st. All major sectors were in the red, and the latest fall takes the decline in the city's benchmark index so far in 2023 to 10.8%, making it the worst performer out of 92 equity indices around the world tracked by Bloomberg. And it's not going to get any better this morning because futures markets are pointing to another decline of about 120 points for the Hang Seng at the open. That's a fall of about 0.7%. You can get more details on the latest market movements in my daily newsletter, which is at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Friday morning guests. Well, we have with us Andrew Sullivan, who is founder of Asian Market Sense. Morning, Andrew.
Good morning.
And also with us David Friedland, who's Managing Director for Asia Pacific at Interactive Brokers. Good to see you again, David.
Nice to see you too.
Let's start in the UK. In a surprise move, UK interest rates have been left unchanged after the Bank of England said price rises were slowing faster than expected. They were held at a 15-year high of 5.25% after 14 rate rises in a row. It was a knife-edge vote. The Bank of England's Monetary Policy Committee was split 5-4 in favour of leaving rates unchanged. Bank of England Governor Andrew Bailey cast the final and decisive vote. And that comes after figures on Wednesday revealed an unexpected slowdown in inflation in August. Bank of England Governor Andrew Bailey said inflation has fallen a lot in recent months and we think it will continue to do so. And the bank said there were also increasing signs that higher rates were starting to hurt the UK economy, and the majority backing the decision to hold indicated that further rate rises were unlikely to be necessary in the coming months. They wrote that the current level of rates be maintained rather than increased until progress has been made in bringing inflation down to the Bank of England's 2% target. Andrew and David, help me understand this. Here we have the Fed, very decisive, saying rates have got to go up further because inflation is still too high. In the UK, where inflation is more than double what we're seeing in the US, the Bank of England's leaving rates on hold and saying they've gone high enough. They can't both be right, surely.
Well, I think the thing is they've been behind the curve for a lot of this, probably the last year, to be honest. They've been aggressive, and I think that like the Fed are just waiting to see whether these moves actually have a real implication to what's happening in the economy.
Yeah, I think some of it also is political pressure. End of the day, the housing market is the front, and the mortgage costs is front page news. So they're indicating that we're not going to raise rates. They're going to kind of help the housing market, which is getting devastated. Otherwise, this is a wait-and-see approach.
I think you're right there, because I mean, one of the key things in the UK is the fact that most of these aren't on fixed-rate mortgages. They're on floating rates. So when these have a real impact quite quickly, probably 2 or 3 months from a rate change to people's spending patterns.
Yeah, and I think hopefully it's psychologically they're saying, look, inflation's getting under control. I think for the first time in a while we'll see markets really taking a hit. So psychologically there'll be less money out there and maybe control for inflation a little bit.
But the Bank of England can't seriously think inflation's under control, can they, in the UK? I mean, they got excited because food price inflation has declined from 15% year on year to 14% year on year. It's sort of hardly a signal that inflation is under control, really, is it?
Well, I think they're doing all they can. Inflation is always a very difficult thing to control. I mean, you're always on the back foot. So, they're doing the best they can. They've been aggressive. They were behind the curve to start with. They came up to the curve, I think, and now they really want to see whether they're the implications of what they're doing.
There's a difference, isn't there? A difference in focus now between the Fed and the Bank of England. The Fed seems to be focusing more on inflation than on the economy, whereas the Bank of England seems to be focusing more on the economy now than on inflation.
Well, I think you have the tale of two different worlds. The U.S. economy has done fairly well. The market's been resilient and strong this year. Earnings numbers have been decent, and employment is still very tight.
Yeah.
In the U.K., the sentiment is bit on the opposite side, where especially food inflation and the cost of electricity have been really hit the economy and hit the people and the general populace quite hard. So I think you have to manage all that.
And I think the other thing you have to remember is that a lot of the mortgages in the US are 30-year mortgages. So once people have locked in, they're not going to move. Whereas in the UK, they're floating rates. So 2 or 3 months down the line, interest rate change makes an effect.
You're absolutely right. It's a direct hit on the pocketbook right away.
You've been in Europe, actually, haven't you, recently, David? Are people noticing price rises? Is it something that they're talking about?
Yeah, and it is. It's actually hitting the restaurant sector quite heavily. We were, just one small anecdote. We were at a restaurant in a small town, and it was doing very well. It was packed. And then we're talking to the owner on the way out, and she was telling us how hard it is right now, and they're suffering, and they're barely making it because they're trying to keep prices down while their costs have gone up, especially labor costs and of course the food side. And I'm sorry. And on top of that, they said electricity. That's been a massive hit for them this year.
Well, I mean that's the key thing for Europe, isn't it? I mean it's gone from cheap Russian energy to realistic pricing.
And now we have oil prices moving up, so maybe we're going to start seeing the inflationary impact of that as well now as energy prices start to creep back up, because it looks like oil is going to $100 a barrel, doesn't it? And particularly after the news today with Russia restricting diesel supplies as well now.
Yeah, it'll be an interesting couple of months coming up, especially as we head into winter.
Yeah, but I mean, I think Europe has actually tried to wean itself off the cheap, Russian or energy pricing, but as you say, I mean, it's a key element to everybody's pocketbook.
I find it hard, though, to imagine that the Bank of England is right when it says there's no need for any more rate rises, and they seem to be saying, the most we need to do now is maintain them at current levels, not raise them, whereas the Fed is saying quite clearly there will probably have to be more rate rises, but I struggle to think that the Bank of England can be right on that, surely.
Well, I think one of the things is actually we haven't really seen the big impact of AI yet. And, a lot of these big firms, they're not employing people, they're doing contracting. Because why would you employ an accountant when you might be able to replace him for $25,000 or whatever with an AI program? And I don't think we've actually really taken that on board yet, that, it's going to be a very radical change in the next 6 to 9 months.
There's been a lot of central bank activity in the last 24 hours, as well as the Bank of England. We had Switzerland surprise markets. They left rates on hold. Norway and Sweden and Turkey all raised them in Europe. Here in Asia, Taiwan, Indonesia and the Philippines left them on hold. The HKMA, also no surprise, of course, they have to maintain their base rate at 5.75%. Now, but what do you see the impact being here, particularly on the housing markets? Because the economy is slowing, isn't it? Rates are pretty high. We've got GDP now at about 1.5% year on year in the second quarter. What's the impact going to be here?
Well, I think Hong Kong is in for a tough ride. The anecdote is, well, it's no secret how many people in Hong Kong are fleeing, going on the short train to China over the weekend and spending there because it's so much cheaper. I was talking restaurants to one of my colleagues in the office, and they said, why would they spend money here when it's half the price or even a third of the price if they just go across the border to eat?
No, I think the other thing is you look at the last land auction. A lot of the companies put in bids, but they were very, very bearish. And actually, I mean, Sino won, but Sino's known to having a very small land bank, so it had to pay up. I thought the most interesting thing about that was the fact that Chung Kong, that had a site very adjacent to that one, didn't pay up, even though the price was probably a third less than they'd paid 18 months ago.
Yeah, but there's a lot of land supply coming on in Hong Kong and office space. Office space coming in Hong Kong, and that's going to be interesting because you have 3 major projects in Central. You have a whole bunch down in Tai Kung Shing and Quarry Bay. It's going to push prices down.
And you look at the new Henderson building, lovely building, a green building, and then you've got Chung Kong's replacement of Bank of America Tower, which we don't know whether it's that compliant.
And what do you reckon about the government's bid to try and boost the night economy? Night Vibes, I think it's called, isn't it? Which seems to be focused very much on domestic people living here, not on tourists at all. Is this going to persuade people not to go to Shenzhen for the weekend and spend their money there?
Unless they got the prices down, I don't see it doing the job. It's just PR.
Well, I think the other thing is at the end of the day, if it's not locally driven, if there's no demand for it, if the government is putting demand in place, it's unlikely to be successful. You cannot force tourism at the end of the day. I mean, and this is the problem we've had. The government shut down over COVID. We lost a lot of the airline routes, and people have gone elsewhere.
And they quite like the idea now of going elsewhere as well, realising it's very convenient to travel to Shenzhen for the weekend, even fly to Japan for a few days and have a break there.
Well, I think the interesting thing was Cathay's numbers came out, I think, on Tuesday. They were quite good numbers, but the stock ended up lower on the day, which just tells you that there's a lot of pressure on that sector.
Mm-hmm.
Interesting, but Hong Kong over the last, since COVID and the changes in the economy and in the politics, lost a lot of... when it ever says expats, it's not just Western expats, it's expats.
It's momentum.
And it's total, exactly. And the schools are suffering, there's less children around, there's less spending in general, and that has to change. And that's only going to change if the economy picks up and firms can need the talent and pay up to bring it in. But if it's so expensive to bring people in, you're competing against China, you're competing against other markets, it's going to take time. It's not going to be an overnight fix.
I think the other thing is, the Greater Bay Area, I mean, I used to work for Haitung, it's like, there is no low-hanging fruit there. As ever, China has said, we're opening this up, but it's only opening up after 20 years of actually having it opened up for the local firms. They're hoping that Hong Kong will spur that market. But the reality is, Hong Kong has always been about taking China to the world, not taking China to China.
Okay, well, we've got another central bank meeting today. The Bank of Japan, they're going to conclude their 2-day monetary policy meeting. Going to be keenly watched for any sign that the BOJ is going to start the retreat from ultra-loose interest rates. I suppose, Andrew, if they do signal they're going to retreat, then we're going to see a massive move in the markets. But unlikely, isn't it?
Well, I think they've already positioned themselves for that, to be honest. They said they're going to do it. I mean, I think the best thing the Bank of Japan said was, when the new governor took over, he said he was going to give himself 18 months, so nobody could front run him. He's given himself 18 months to change policy. He will do it in his own time.
I kind of laugh a little bit. I wonder why they even meet, because you know what's going to happen.
That's a good point.
At some point...
It's the only way they get paid.
Yeah, but at some point something has to change there. It's... You can't fight negative rates against the rest of the world at 5%, 6%, 7%.
Well, I think the other thing is, though, as well, Japan has never needed low interest rates. I mean, companies are not desperate for cash. The real crux of this is the fact that CEOs do not borrow money unless they think they can make money. It doesn't matter how cheap you make it, unless they can make money, they're not going to borrow money. And that's been, and the only thing it's really hit is, you go back 15, 20 years, Japanese tourists used to be the best people in the world, because they were getting 5-6%, and they knew they could. Today, they're hiding behind their savings and hope they survive.
Do you think we could see a change in the yield curve control policy, either at today's meeting or before the end of the year?
Well, I think everybody hopes that Kuroda, now that he's on a pension, might have a change of opinion.
Yeah, but he can't do anything about it now, can he? He had his chance.
And he didn't change.
What do you make of what the Fed did and said on Thursday? The key thing seems to be the dot plots, doesn't it? That's where people were most focused on. And what was absolutely clear is that policymakers on the Fed are revising up their outlook for interest rates and also cutting the number of rate cuts that they think there's going to be next year. They were originally projecting 4. Now they're saying only 2 rate cuts next year. I'm wondering if that may actually get to 0 before too long.
Well, I think the key thing here is at the beginning of the year, everybody was fighting the Fed. Everybody thought that, no, they'll cut early, whatever. And Powell has consistently said, no, we are going to keep rates high, we're going to keep them higher for longer. But nobody believed him. And he's just gone again. It's like, no, there are going to be no rate cuts. We haven't got inflation under control. And until we do, nothing's going to change.
I think you bring up a good point. It's taken him a very long time to gain credibility. And now that he has it, I think he can say something and he can move the markets very slowly, very tightly, but he bought himself some time by saying, yeah, we may make cuts, we may not.
Well, I think the other thing as well is, I mean, they've got a very strong labour market. I mean, even though we've got these, these strikes in the auto industry, but I think the key thing here is, AI is making a difference. People aren't quitting jobs because they're worried. You can't get cheap auditors because there are AI programs that will replace them. And a lot of these people are realising that their jobs aren't safe.
But it's not being reflected in the unemployment data, is it? The unemployment data still shows that, people, claims for benefits are falling a lot more than people thought, which tends to suggest they have confidence that if they do get unemployed, they're going to find another job.
But I think you have to look at where the unemployment is. I mean, you aren't getting auditors lining up for jobs anymore. Mm-hmm. And this is something that AI can replace very quickly. You can get an AI program that's equivalent to a McKinsey accountant, whatever. It's in and the creative people. We've still got this strike in the actors union because they realise that their jobs are under threat.
Mm. So it seems that Jerome Powell has put himself in quite a nice position because he's got everyone thinking that there's going to be another rate rise before the end of the year. So he's now put himself in the position to surprise everyone by not doing it, hasn't he, by the end of the year, as opposed to the other way round, which is where the Bank of England is in, where they've let everyone think there won't be any more rate rises and they could end up disappointing.
I think you're right. I think he's finally got to the point where he keeps the markets guessing and therefore he has more power.
Yeah, they were behind the curve and they've got ahead of it.
Mm. Well, the big reaction has come in the markets, of course. We've seen the 10-year bond yield now at a 16-year high. In fact, let me just get the data for all of those bond yields that are out there. The 10-year, right, here we go. The 2-year yields, highest since July 2006. 5-year yields, highest since August 2007. 10-year, highest since November 2007. The 30-year, highest since April 2011. I mean, we're looking at historic moves here, aren't we, in the bond markets? This is just not the sort of things that you see. 400 basis point rate increase in 10-year yields over 3 years. I mean, these are extraordinary moves which presumably are going to have consequences.
I think they will, but are we moving back to the norm? I mean, we had 10, 15 years of historically low rates, basically no rates at all. And it's about, it's a realization. You have massive debt out there. How are you going to finance it? The long-term rates are here to stay. I think is what the market is finally realizing or recognizing.
Well, we've never unwound QE. I mean, when it first came in, it was a great idea. But, everybody's kicked the can down the road for effectively 15 years, and now somebody's got to pay the piper.
Mm. And you've got mortgage rates now in the US above 8%, new car loan rates are nearing 10%. That's a record. This is going to have impacts, isn't it, on the US? I mean, you're not going to sell your home now, are you? Because there's no way, if you've got a mortgage at sort of 3%, you're going to want to refinance at 8%. So presumably this is going to knock housing market activity right on the head.
Well, we've already seen that, I think. I mean, I think you're right, yeah. And the US is one of the few places that you can lock in a 30-year mortgage. I mean, it does mean for people like, the house builders, it's only new supply. You've got the people that are, supplying them with air conditioners and people like Tektronix that are, the people will be refurbishing, not moving. But I think you also got to take into account that, new purchases are just not going to happen. People are going to go, the ladder is too high.
This is, I'm wondering if, these high yields, they're a bigger problem for people outside the US than maybe they are in the US, because it's driving the dollar higher. It's making the cost of borrowing pretty high, isn't it, in other places around the world?
Yeah, well, definitely there is a ripple effect elsewhere, particularly Hong Kong, but we're feeling it here. And it will impact global markets, and everyone has to basically chase and follow it. But there's, at some point you have to deal with the debt. You have to deal with all the systemic problems, and housing will come to a head. The rental market is obviously doing phenomenal because people are renting, but the whole economy has changed so much. You work from home, and do you go to the offices anymore? Real estate's going to be office real estate's going to be massively impacted, probably more so than it is now with AI coming. I don't know if any of you have been to offices in the States or in Europe or even Hong Kong. Maybe half the people in the office, if you're lucky. Other offices, basically 1 or 2 people come in on a Friday. So the world's changed, and where are people living, where are they staying? It's still evolving.
And what's the impact going to be on US stocks of this? So we're starting to see it already, aren't we? We're seeing a rotation now out of the tech stocks, which are pretty hit by higher interest rates, moving into more defensives. Utilities have been outperforming now. Is that going to be the trend for the final quarter of the year, do you think?
I don't think people have really taken on AI yet. I mean, you look at a lot of these stats about employment. I mean, people aren't employing new accountants because they know that they can get an AI program to replace them. So there's a lot of contracting work going on. And that means that a lot of these companies are going to still come out with good results because they're going to save on cost. They're going to use AI. They're going to use computer power. It's a change.
So would you still buy these chip companies like Nvidia that are, up, about 180% at one point this year, weren't they? I think they're still up, not quite as much as that, but...
Well, you look at it, I mean, Meta came into it late, but realistically, I think you've got to look at, Huawei have just come out with a new chip that they've managed to reconstruct the technology. The key thing for this is actually, Nvidia is expensive now. But you look at the use of these, modern chips, they are a huge drain on power. So you buy the power companies, you buy the memory companies, you buy resources because people are going to have to transfer energy from solar or from wind or from the sea. There's a radical change taking place.
Yeah, and at the same point, demand's still going to increase in tech because you have to. It's more effective paying for a computer chips, and all the peripheral devices than hiring a person ultimately.
Well, you're not going to buy, you're not going to hire a McKinsey analyst at $150,000 a month, a year. Sorry, and when you can buy it download it for $25 a month.
Let me finally get your thoughts on local markets here in Hong Kong. The Hang Seng's tumbled now to a 4-week low. It declined for the second straight session, lost 230 points, currently at 17,655. The decline now for 2023, almost 11%. It's the worst performer out of any major equity index market in the world, about 92 of them, which are tracked by Bloomberg. What are your thoughts, first of all, on what's gone wrong for Hong Kong, and do you see any sort of ray of light at the end of the tunnel for the final quarter of the year?
Well, I mean, the Hang Seng and the Hong Kong markets in general are heavily dependent on China, and the China economy has been a rough ride. And a lot of Chinese companies listed in Hong Kong, and the earnings are dependent on China. So as long as the China economy is in a little bit of a doldrum, Hong Kong is going to suffer.
I mean, I think it's quite interesting, isn't it? I mean, you go back 10 years, we had China Mobile, the property companies, the telecom companies, and the stock exchange decided that they wanted to be more tech. And that's been a really bad decision at the end of the day. I mean, the property company, Sun & Kai's price, if you look at it, hasn't changed very much after the last 20 years. It still pays a good dividend. It's still a diversified conglomerate, but it's not the weight that it had. And I think the thing for Hong Kong at the end of the day, you go back 15 years, everybody knew there was a premium for the risk in China. But it was only when they changed policy on Macau, on education, on e-commerce, that people actually realised that premium was there for a reason. And the confidence has gone. People have been burnt. You look at the volume every day. We're now at, 70 billion a day. We used to be at 150. That is because people were burnt and they've gone away. And they're not going to come back until they get certainty that... And this is the lovely thing about China. They've always said, look, we don't make mistakes. We don't have the problem with elections, so we have constant. But they suddenly changed their mind, and that shocked the market. And a lot of people shocked, hurt, lost money, and they can make money at 5% just with treasury bonds in the US.
Yeah, I think as long as interest rates are high, you're going to be. Do you keep your money in Hong Kong or do you move it to dollars? We're pegged to the dollar. Why not get 5%?
Well, what's interesting is foreigners. I mean, they sold in August 90 billion yuan worth of stock through Stock Connect. They've already sold, that was a record, already sold 24 billion yuan so far this month. Presumably, the foreigners, who are now heavily overweight, they're not seeing enough yet to make them want to come back, despite the cheap valuations, I presume. The Hang Seng Index is trading now at about 8 times price to earnings, 8.4 times forward price to earnings. Pretty cheap, but not enough to tempt people back.
Well, no, but I think you have to look at things here. Huawei is a great company, but it's not listed. They have managed to get round the sanctions in the US and come up with a comparable chip. even though the technology is skewed against them. And I think that's the interesting thing. People say that China is uninvestable. It's not. You just have to find sectors that are very much in line with what the government wants to do, and they're going to be backed.
So electric vehicles and the like?
Well, yeah. I mean, look at it. They've taken over, the Internet of Everything. They put more patents out there. Huawei has done that. Even though the US sanctioned it, to the hind teeth, it has succeeded in being there and setting the specifications. US firms, if you remember, when we came in with 4G, 5G, China came up with its own one and it didn't work. What it realised is actually you have to be in the specification side so that everybody has to follow your lead. That's what they've done. They've done that with batteries, they've done that with EVs, they did that with solar, and they will focus on doing that again.
Yeah, and at the end of the day, it's a stock pickers market. So you have to be selective in what you do. The real estate's going to be suffering for a bit, but
for my kids' education.
Yeah. Yes, for a long time, and then. But the select, as you said, the select tech stocks out there, there's some great finance companies, but the valuations have been very high for a while, and it's put them back in line. Now you have to go pick the right stocks.
I think the other thing is, you're talking about valuations there and tech stocks. I mean, Alibaba, Tencent, they were world leaders, but the government decided that actually ethics were more important than profit, and that's what Xi Jinping's done. He's changed the market around. And unless you're in line with what he thinks, you're not going to make money.
Yeah, and then you bring one very good point is, you have a company, you invest in it, you do all the research, and if the rules change, there's a risk premium. There's so much uncertainty. Why would you put your money in a certain stock if you're not sure what the rules will be down the line? And if the goalposts keep changing, go to something more stable and.
Well, I mean, the US, it will take 5 years to change policy. You have to go through committees and everything else. In China, we've woken up to the fact that actually if Xi Jinping gets out of the left side of the bed, everything can change overnight. Sure. And that's a worry.
Yeah, and then of course you have the geopolitical mess that's going on right now, and it's
well, you can't get the information.
Yeah.
So how can you invest if you don't know what the ground rules are?
What do you make of this information from the Hang Seng Indexes company about stock buybacks? They've reached $11.9 billion this year. That's 4 times higher than the prior 5-year annual average. They've already reached 73.5 billion Hong Kong dollars up until September the 15th, which is about 70% of last year's total. Now, buybacks can sometimes signal, can't they, that corporate directors think the shares in their companies are cheap. Do you put much store by this news?
I've never understood stock buybacks, frankly, because unless you basically signal to the market, you have all this cash, you don't know what to do with it, you don't know how to put it in R&D, you don't.
You can't invest it.
You can't, exactly. So why not either give it back as a dividend, which would be the same effective thing as buying the stock. So I think it's a negative signal personally, but it's the mindset here is buy because our stock is low. We're going back up.
But I think you look at the companies that are doing it. It's, Tencent's buying back, the banks are buying back, Meituan's been buying back. Yeah, stocks that are under pressure are buying back because they are actually cheap, and as you say, they've got this cash, and they have no idea what else to do with it. So why not buy your own stock back? And I think the other thing is actually a lot of the directors, their compensation is linked to what happens with the share price. So if you've got spare cash on the balance sheet, why not use it to help yourself? And
you can also be big at building up some treasury stock to get the staff as compensation down the line as well. But I just think it's better.
It's not invested in R&D. So these guys are not investing in their future at the end of the day.
Exactly.
Okay, well, thank you very much for your thoughts this morning. Have a great weekend. You heard there David Friedland, who's Managing Director for Asia Pacific at Interactive Brokers, Andrew Sullivan, who is founder of Asian Market Sense. I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Yeah, good morning, Peter.
A lot of action in the last 24 hours from central banks all over the world. In Europe, we had the Bank of England and Switzerland leave rates on hold. Norway and Sweden raised them. Here in Asia, Taiwan, the Hong Kong Monetary Authority, Indonesia, Philippines left rates on hold. The Bank of Japan is meeting today, also expected to leave rates on hold. Let me start, Toby, with the Bank of England. They left, surprisingly maybe, left interest rates on hold at 5.25%. That brings an end to sort of 14 rate rises in a row. It was a very close decision. The Monetary Policy Committee was split 5-4, and Andrew Bailey had to cast the final and decisive vote to decide to keep things on hold. And he focused on inflation. He said inflation has fallen a lot in recent months. What I'm struggling to understand here is the difference between what the Bank of England has done and what the Fed has done. The Fed has made it very clear rates are going to go up. Inflation's still too high. In the UK, inflation is more than double what it is in the US, but they're saying rates are now on hold. Doesn't seem to make sense, does it? One of them seems to me is going to be wrong.
Yeah, well, firstly, I think it was rather a line ball decision whether to tighten again. They've increased interest rates in the UK by 515 basis points in the last 2 years. They had a double-digit inflation, which has come down to a 6 handle. So in line with some of the other central banks, I feel like now's the time for a pause. I don't think it's the end necessarily. So you can differentiate that from the Fed, which is a little further along in terms of the trajectory of rates. So the UK's now sort of where the Fed were a few months ago, saying, right, we're in a chance for a pause, whereas the Fed have sort of kept their language fairly hawkish. And this is, we discussed this previously. The central bank wants to keep a foot on inflation. It doesn't want to create any expectation that they're comfortable with inflation in the 4 handle. They need to get it back to 2. So hence the language this week of the Fed was really about saying, hey, we've got another one in the pipe. If we're not seeing, further decline in inflation, which you have seen obviously in the US, but it's starting to slow. And so on that basis, I think the Fed have had a clear delineation from what the Bank of England have, which are sort of now into that phase where they're into the pause, which doesn't necessarily change the direction of interest rates in the UK, but probably gives them a little bit of breathing space.
The 5 MPCM members who voted for the pause said the current level of rates can be maintained rather than increased. It's hard to imagine that the Bank of England is going to be right there, is it? That there's not going to be any more rate rises in the UK. I struggle to think with inflation, 6.3%, food inflation, almost 14%, that there's not going to be any more rate rises.
Yeah, real rates are 5.25, so similar to where the US rates are in short end. I think if inflation can persist in that 6 area, for sure, you're going to see higher rates. And clearly, if ECB and who are around 4%, and then US go say 5.25 to 5.5, then you would definitely price in another one in the UK, potentially more. So I think that's a reasonable thesis. But what's most interesting now is some of the data starting to emerge out of the US. Even with the Fed saying that GDP will be better than expected, we're starting to see some figures that are reflecting the impact of the higher interest rates, home sales, Fed activity starting to, impinge a little bit.
But then you get other data like the unemployment data that we had overnight, which suggests sort of that things are still looking pretty good. I mean, it still looks like it's a pretty tight labour market, doesn't it?
Yeah, that's been a bit of a conundrum, for central banks and for most of the Western economies post-COVID is the tightness of the labour market has persisted despite a very aggressive tightening schedule. You would expect, not just in theory but in practice, that you would see a bigger decrease in employment through the cycle. And it just hasn't happened as expected. So you're right, it's the tight labour markets has probably got most central banks, concerned. And actually, when we talk about tight labour markets, what they're concerned about, and I think we've used this before, is not the actual amount of labour, but the productivity of labour in this recovery out of COVID is not the same. So that also adds to cost, which means inflation can be persistent even when you're seeing some slowdown in the supply chain inflation, the cost push stuff.
I mean, what the Fed has done this year has been one of two things, hasn't it? They've either raised rates or they've kept them on hold, which they've done twice now, but it's been a very hawkish hold. They've said, even though we're on hold, more is coming. Don't think this is the end. What does it mean now for the Bank of Japan, who are meeting today? They've got a pretty tricky decision to make, haven't they?
Yeah, I think the forecast is for them to stay the course. What are they at 0.1? They're not likely to move, but they're they've got a yen at 148 plus, I think, in terms of its depreciation against the dollar. So it's possible that they might look to intervene by raising either rates or at least an expectation of rates to try to respond to that. Different dynamics in the Japanese economy. They have a history of being in such a deep deflation that they're very, very reluctant to avoid tightening things up. You know, they want to give as much chance for velocity to come into the economy. So I suspect they'll probably be on hold again, but let's see what the language is around what they do. And yeah, they're probably, if they're looking to see, to put some yen strength in, they may look to tighten or at least change the language a little bit.
And this is the problem for them, isn't it? It's the yen, which is sliding quite rapidly towards 150. And although they talk about intervening, they haven't done so far this year. But presumably this is where the Fed is putting pressure on Japan through the currency and the stronger dollar.
Yeah, and the problem when you start trying to tell the market about your currency expectation, the market sort of tends to push you the other way. So, you know, jawboning a stronger yen isn't going to work. It'll have to be policy decision that'll drive the market to reprice the yen. So at this stage, even talking about trying to get a stronger yen or intervening in terms of open market operations or whatever to try to defend the currency isn't going to work. It actually ends up often having an inverse effect because the market starts to see a bit of panic, starts to push the central bank authority. So I'm inclined to think that if they're really concerned and they want to do something about it, they'll probably raise rates. But I think the forecast in the market is for them to hold it again.
And the People's Bank of China is in the same boat, presumably, in that it also wants to stem the decline in the yuan. It certainly can't raise rates with the state of the economy, so it's down to jawboning or the fixing to try and push against it.
Well, China can intervene from a fixed perspective. It's not a floating market, essentially, even if they try to do so. So they have the capacity to intervene in terms of where they are in the cycle. They're into a bit of a deflationary cycle, but they have more capacity to intervene, and politically they have more capacity to intervene. So we'll be interested to see what PBOC do, because that'll be driven as much by what the politics are required in the domestic economy in China.
Let me ask you about the market reaction to all of this week. The key thing is really in the Treasury market, isn't it, with Treasury yields? Just to put some context around it. 2-year yields are now at their highest since July 2006. 5-year yields at the highest since August 2007. The 10-year, the highest since November 2007. And the 30-year at the highest since April 2011. These are sort of historic moves that we're seeing in the bond markets at the moment, aren't they?
Yeah, and you're seeing the curve steepen, which is an interesting shift. So even though we're seeing higher short rates, the long bond is starting to move up, and that is the more significant aspect when it comes to pricing equities and ultimately most debt, right? So the 10-year is the one. So the 10-year, the curve steepening, 16-year highs, as you mentioned, 4.5% in the US. And if you want to look at a flow-through effect on how market sees that, not only have you seen interest rate-sensitive stocks in the growth sector like the NASDAQ dropping quite sharply, but volatility rose 15% overnight. And I think it's a clear reflection of the breakup in bond yields. And that's something we'll keep an eye on, because vol's been, down to 13%, now back over 15% overnight. That was over 17% overnight, a 15% move. So clearly a technical break on bonds, and as the 10-year is the one to watch, because that will be reflected in earnings yield and therefore equity prices. And you've seen overnight in the last couple of days equity starting to move quite sharply lower, particularly on the growth side.
I'm wondering, this has consequences, doesn't it, this sharp rise in yields, both domestically in the US and also overseas as well. I mean, domestically, mortgage rates are at 8% now, car loan rates are at 10%. This is going to have a big impact on people refinancing. They're just simply not going to consider selling their homes, for example, if you've got a mortgage currently at around 3%, only to then end up with a mortgage at 8%.
So home sales were down again, 0.7, third month in a row. In the US, home sales are down. Mortgages are fixed at the 30-year pretty much. So in terms of the impact on the borrower, whilst their terms are long, rates are fixed, that type of stress necessarily won't be a dislocation. Here in Australia, it's a bit different. Of course, you have a lot of variable mortgages, and then you have fixed mortgages coming off after short periods of fix. And the repricing of those, has been a huge amount of refinancing of loans, people trying to extend terms, duration in particular. So that activity is on and going here in Australia. We really notice it, but hasn't necessarily fed through to prices coming down. Different dynamics at play in Australia, of course. But yeah, I think it's clearly some of the stress that you would expect from the interest rate rises we've seen in the last 18 months should be starting to feed through, and maybe we're starting to see the signs of it.
And the other way it's having an impact on overseas markets is through the dollar as well, and on overseas investors. The dollar's strengthening, which is impacting borrowing costs, well, all over the world, really, isn't it?
That's right, and so those those parameters start to shift, and you start to really feel it. That lag effect of the higher interest rates and the curve going inverse, are now starting to play out, which is actually in line with the expected timetable of potential recession, 18 months to 2 years from the inversion. So, people sort of look back and say, well, it's actually, what's happening is not unreasonable given what the timelines around inverted yield curves and changes in dynamics with higher interest rates.
Let me ask you finally, switching topics, I want to ask you about India, this extraordinary dispute between India and Canada, which almost seems to have come out of nowhere, doesn't it? But has severely damaged relations between the two countries. They're expelling diplomats. India's no longer issuing visas for Canadians. Canadians are pulling out people from India. They're talking about travel advisories. I mean, what on earth is the impact of this going to be? Because this relationship is an important one, isn't it?
Definitely important. I think it's the fourth largest. Canada's the fourth largest exporter of coal to India. And actually, interesting, I was reading the Economic Times of India this morning, and one of JSW Steel, one of the big steel companies in India, has slowed an acquisition of a coal company, Tech Resources in Canada, maybe just a delay. Now, the way in which is not to overreact to these situations is I look at it, the Khashoggi murder, with Saudi that happened. There's a major amount of disconnect with from a geopolitical perspective, but sort of people have moved on from it. Even if there was condemnation, less of a more dramatic one was the Australian-French submarine deal that went that Australia walked away, caused a major diplomatic incident. Australia and France are now back on track. I suspect that there's a lot of noise, heavy rhetoric now, because India will want to clearly defend itself. Canada, on the other hand, is doing what it should do, which is it has a criminal investigation going. It doesn't matter if they've got credible evidence that someone, that there was evidence of involvement from another nation state, then they've got no choice but to investigate it. And I don't think the Canadians would ever abdicate that responsibility. The rule of law applies. So it's messy. It's concerning. I think it's way too early to suspect that it'll have long-term implications, but right now it's a very, very tricky situation for both countries. And what you would hope is that they let the investigation happen, and that the diplomatic furor sort of dies down and they get back on track. But we'll wait and see.
And presumably this is sort of put on hold plans for a trade deal. They were talking about a trade pact by the end of the year. That got put on hold just before the G20 summit. Hopefully that will get back on track. But for now, it seems to have been postponed.
Yeah, and that's this will happen when you have diplomatic spats. I mean, it's a serious incident. If there was, regardless of the individual, regardless of what happened, if it's a Canadian citizen who was murdered on Canadian soil, and the investigators have evidence that it was potentially a foreign nation involved, they have no choice but to raise it. And I think, you've got to admire Canada's strength in this regard, regardless of the consequences of the relationship. We don't know. Let the investigation play out. India is reacting as you would expect, because, they're obviously defending their sovereignty. But let's see. I think, sometimes these things have maximum noise early because there's a lot of attention to them, and then hopefully they can simmer down and they can get back on track.
Okay, Toby, well, it's good to get your perspective on that. Very level-headed perspective indeed. Thank you very much. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Tim Huxley, Chairman of Mandarin Shipping. Providing a view on mainland China will be China specialist and author Mark O'Neill. Have a great weekend.
Money Talk.